Yeah, it's a great question, and there's not a day that goes by that probably all of us don't get asked about. Isn't the market too high? And valuations seem extraordinary here. And I think there's a couple of different ways you have to think about it, right? You've got to think about it from purely looking at equity valuations relative to their own history. And we run a really simple four-factor model that looks at price to book, price to sales, price to cash flow, and price to earnings. Equally weight those four metrics and then look at where the markets are relative to their own history. I don't think it comes as a great surprise to anybody on this call that we're expensive, right? Several of those are in kind of 95th percentile valuations. So in and of themselves, kind of relative to history, equity valuations are expensive. But as an allocator, right, if we have to allocate a dollar across the markets, then we have to look at equity valuations in that context. And I think if you think about, from an allocation perspective and where I think the best returns are going to be over the next 3, 5, 7, 10 years, I start looking at equities. I look at where fixed income is, and I say, relative to the other asset classes, equities provide better forward-looking return prospects. So again, I think, most people would say by traditional metrics, stocks are expensive. And I don't think it matters really what segment of the market you're looking at, right? Whether it's large cap growth, EM, mid value, whatever, equity valuations are above, historical averages, well above historical averages. But again, as an allocator looking across the markets and thinking about where do I want to, put my dollar for the best prospect, equities look, inexpensive relative to other asset classes.